We're going to now turn to Carl Denninger of Market Ticker. He's an expert in all of these things, and he's got tremendous following on the web. So let's say hello now to Carl Denninger.
Hi, how you doing, Max?
All right, thanks for coming on the show. Carl, this week you wrote on your site, Market Ticker, that's market-ticker, that Geithner is a stooge for the bankers. Why is that?
Well, primarily because that's where he comes from. Geithner came from the New York Fed, and if you take a look at what the New York Fed was responsible for over the last 10, 15 years, they are the primary party that deals with all of the various Wall Street banks and handles monetary policy and its implementation. So Geithner is a banker's banker, and his policies and his actions throughout this crisis and in the time leading up to it have all been geared towards trying to find ways to allow the bankers to make more and more money. It has nothing to do with managing the Treasury's goals, which are, or at least should be anyway, protecting the taxpayer interest.
Yeah, now recently before Congress, he refused to answer some questions.
Yes, he did.
Tell the people about this.
Well, the most recent example of this, and there are many, was the question about credit default swaps, whether or not the Treasury would refuse to backstop any credit default swaps that were written today. Not the historical stuff that was written 5 or 10 years ago or 6 months ago, but the stuff that, say, J.P. Morgan or Goldman Sachs was underwriting today. So if I went and bought a credit default swap from Goldman Sachs this afternoon, and something went wrong with that deal, whether or not he would commit that Treasury would not bail out Goldman Sachs. And again, not on the historical stuff, but on the stuff that was being done today. And he refused to answer the question.
All right, let's talk about it just for a second. He was obstinate in front of Congress, and as far as I'm concerned, I think there's a word for that. He's in contempt of Congress and probably should be in jail for contempt. But talking about credit default swaps for a second, just to give the viewers an idea of credit default swaps, I think the easiest way to describe credit default swaps is that over the past 10 to 15 years, as these banks started to hit their limits in terms of their equity to loan ratio, they invented all kinds of flora and fauna of these financial derivatives, which have no real purpose in the banking system. It's just a way to create more leverage, to create more trading, to create more fees, and just create another layer on this huge, humongous Ponzi scheme, which is underwritten by these global banks. The technicalities of a credit default swap are not really that important, it would seem. It's just really the thing to keep in mind is that it's a layer of fluff that now, along with these other layers, is crashing. Your thoughts?
Yeah, essentially. I mean, a credit default swap is ostensibly a way to shift the risk of a default, that is, that somebody isn't going to pay you, to someone else. The truth of the matter is that there's no shifting going on. If the person who sells it to you doesn't have any money, then what you bought is nothing. And we saw that with AIG.
Right.
AIG wrote $500 billion worth of this stuff, and they had no money. So when the time came to pay, they didn't have the $500 billion, and the entire thing collapsed around their ears. The problem is the banks have claimed that all of these positions that are protected by these swaps are safe. And their argument for the claim is that they have these credit default swaps. But it's like gambling with a bookie, where the bookie doesn't have any money to pay off when you win. It's great when you lose; he takes your money. When you win, he doesn't pay.
Let's talk.
And so
that's right.
That's essentially what this is about.
A credit default swap was an invention to allow for trading in these leveraged securities where there was no requirement for any reserve whatsoever. So it's insurance without reserves, or as you say, it's bookies without any ability to pay off the bookie. Let's move for a second to Donald Cohn, his testimony. He's a Federal Reserve Vice Chairman. He testified in support of the Fed accepting one of the role of systemic risk. His testimony, he said, any substantial erosion of the Federal Reserve's monetary independence likely would lead to higher long-term interest rates, and investors would begin to fear inflation. Your thoughts on that?
Well, that sounds like a threat to me. Do what we want, or we're going to start to pull liquidity out of the system, crash the equity markets, and drive interest rates higher.
Isn't that what we saw with Hank Paulson last fall? Didn't he basically put a gun to Congress's head and threaten that if they didn't give him the money, they were going to blow up the markets? So isn't this just a repeat?
It's much worse than that. In the fall, and I wrote about this at the time in September, the Federal Reserve pulled over $100 billion out of the banking system at the time that they claimed that they were providing extraordinary liquidity to the markets. In point of fact, Ben Bernanke did the exact opposite, and 3 days later, the dive in the equity markets that started in September began. The day after they did that, Washington Mutual collapsed. Now, you can't prove that one thing caused the other, but the data is right there, and it's in the public domain. I sent this to all 535 members of Congress, and nobody paid any attention to it whatsoever, but your 401k sure paid attention to what happened.
Right, you can't prove it because there's no transparency. Donald Cohen is arguing against transparency. Isn't the only real financial entity out there that thrives on lack of transparency is the Ponzi scheme? And isn't this just a huge Ponzi scheme?
Well, it's all part of the same thing. I mean, the entire purpose of shielding transparency is to prevent price discovery and allow people to play games with the spreads. If I can keep what things are trading for private, I don't have to let anyone see those numbers, then it becomes extremely easy for me to manipulate that market and take an incredible amount of money out of it. This disadvantages everybody except the person who's doing the hiding.